Not long ago, when a business was described as healthy, it usually meant one thing: growth was coming next. Healthy companies expanded, they hired more people, opened new locations, invested in new products, and pushed into new markets. Strength was closely tied to momentum. But right now, something unusual is happening. Even businesses that look strong on paper, solid revenue, stable profits, good cash flow, are cutting back. Hiring freezes, budget reductions, paused expansion plans, and it's happening across industries. So the question is, why are healthy businesses suddenly acting like they're in survival mode? The answer starts with a shift in how companies define risk. For years, the business environment rewarded expansion. Interest rates were low, capital was easy to access, and demand was relatively predictable. If a company was doing well, the logical move was to double down and grow faster. That environment has changed. Today, uncertainty is the dominant factor. Interest rates are higher, borrowing is more expensive, and future demand is harder to predict. Companies aren't just thinking about how to grow, they're thinking about how to avoid getting caught off guard. And that changes behavior quickly. Even if a business is performing well today, leadership teams are looking ahead and asking a different question. What if conditions get worse? That mindset alone is enough to trigger cutbacks. Another major factor is the cost structure of modern businesses. Over the past few years, operating costs have risen across the board. Labor, energy, logistics, technology, compliance. Some of these costs have stabilized, but they haven't returned to previous levels. So even if revenue is strong, the margin for error is smaller. That means companies need to be more disciplined. Instead of expanding aggressively, they're protecting profitability. They're making sure that if revenue slows down even slightly, the business can still operate comfortably. And the fastest way to do that is by cutting back early. There's also the issue of demand visibility. In the past, companies could forecast demand with a reasonable level of confidence. Consumer behavior was more predictable, and economic cycles moved at a slower pace. Now demand can shift quickly. Consumers are more cautious. Businesses are delaying spending. Entire sectors can cool down faster than expected. And when that happens, companies that expanded too quickly can find themselves overextended. So instead of reacting late, many businesses are choosing to act early. They're slowing hiring before they need to. They're reducing spending before margins are pressured. They're essentially building a buffer. And that's why the cutbacks feel sudden, even though they're actually preventative. Another key reason is the change in investor expectations. For a long time, growth was the priority. Investors rewarded companies that scaled quickly, even if profits were thin. The focus was on capturing market share and expanding as fast as possible. Now, the focus has shifted. Investors are paying closer attention to profitability, efficiency, and cash flow. They want to see businesses that can operate sustainably, not just grow aggressively. That puts pressure on companies to adjust. Even if they're healthy, they're being evaluated differently. A company that continues to spend heavily in a cautious environment might be seen as risky rather than ambitious. So they respond by tightening operations. Cutting costs becomes a signal of discipline. And discipline is now being rewarded. There's also a psychological element at play. Business leaders are watching each other. When large, well-known companies start cutting back, even if they're profitable, it creates a ripple effect. Other companies interpret that as a signal that something might be changing in the broader environment, so they follow, not because they're in trouble, but because they don't want to be the last to react if conditions shift. This creates a kind of chain reaction. Healthy companies cut back, which makes the environment feel more cautious, which leads other companies to cut back as well. And suddenly it looks like everyone is pulling back at the same time. But underneath that behavior, there's a deeper shift happening. The definition of health in business is changing. It's no longer just about how well a company is performing today. It's about how resilient it is tomorrow. Can it handle a drop in demand? Can it operate with higher costs? Can it survive a longer period of uncertainty? Those questions matter more than short-term growth. And they're driving decisions in ways that aren't always visible in headline numbers. There's also the reality that many companies expanded aggressively in the past few years. They hired quickly, invested heavily, and assumed that demand would continue at a similar pace. Now, some of that expansion is being re-evaluated. Not necessarily reversed completely, but adjusted. Roles that seemed necessary during rapid growth are being reconsidered. Projects that made sense in a high-growth environment are being paused. It's less about cutting for survival and more about recalibrating, bringing the business back to a more sustainable level. And then there's the long-term strategy. Some companies are intentionally becoming leaner. They're using this moment to streamline operations, improve efficiency, and focus on core areas. Instead of doing everything, they're choosing to do fewer things better. That can look like a cutback from the outside, but internally it's often seen as strengthening the business. Because a leaner operation is more flexible, it can adapt faster, it can respond to changes more effectively, and in an uncertain environment, that flexibility is valuable. So when you see a healthy business cutting back, it doesn't necessarily mean something is wrong. In many cases, it means the opposite. It means the company is aware of the environment it's operating in. It means it's prioritizing stability over speed. It means it's preparing for multiple scenarios, not just the best-case one. That doesn't make the cutbacks any less real, but it does change how they should be interpreted. Because this isn't just about cost-cutting, it's about a broader shift in how businesses think about growth, risk, and resilience. The era of grow at all costs is fading, and what's replacing it is something more measured, more cautious, more focused on sustainability. So the next time you hear that a strong, stable company is cutting back, it's worth looking beyond the surface. It's not just a reaction to the present, it's a strategy for the future. And in today's environment, that kind of strategy is becoming the new definition of healthy.